Hello everybody, my name is Ogdn Ames. I'm the president of Ames Investment Systems that uses algorithmic investing to basically trade people's money. And well, I haven't made one of these videos in a while. Well, probably before I actually started my whole Ames Investment Systems endeavor, but we are back because some bad stuff might be getting to happen. So let's kind of get into that. So first, I'm going to go over some technicals. So I'm just going to break down it all. So of course, this is the 180-day moving average, and then this is a 12 EMA. And when I used to trade stocks myself, this is the setup I would like to use. An SMA, an SMA, an EMA, and then the RSI, and I kind of would get as other like I guess influencers online, they make it seem a lot easier than it actually is because a lot of it is intuition of like knowing where the market is knowing where the market is. um, but yeah, essentially I would like to just break it down real fast. So currently it is on a downtrend, so it's on a downtrend, and that's not very good for, of course, the markets. um, and you can either look at this in one of two ways. You can either look at it as, oh, it's bouncing around this trend and it is getting really close to just, it's either going to go up or it's going to go down at this point, because this is a breaking point. If it goes above basically this trend line and it finally gets above the 180 day, it's going to become a buy essentially, and the stock market is going to begin to rally, and that's not very, and it's good, but it's not very good for traders and fundamentally because, of course, it is in a downward trend. So what am I predicting is going to happen? Well, I'm going to say it's around a 50-50 chance that it's going to continue to go up or down. I know that's not a very good um, way to put it, but essentially you got to think of it as there's a coin flip. And with the coin flip, there's a you basically set your indicators for it. All right. So if we zoom in here all the way, now this is on the day chart. So you can kind of see what's going on here. All right. So you got a hard, strong resistance, but I'd say that there's a 50-50% chance because it is in a channel. I mean, this does look like a crap channel, but it is in a channel. And what we can do with channels is that, I mean, especially if they're horizontal, they almost have a 50-50% chance of breaking up or down. And I mean, just set your indicator. So if it goes below, if TQQ goes below 1646, I would start shorting and buy SQQ. And if it goes above, I might take a half position at 2520. Um, at 2520, somewhere around November 23rd. Now that is kind of far out, but somewhere around November 23rd, if I'm taking a longer term swing trade, then yes. Then if it breaks above the 180 day, like fully, so if the candle completely crosses, like say right here, so this candle did not cross, even though it looks like it did. It actually crossed on this candle right here because it started and ended the day fully above the 180. So, I mean, I wouldn't buy here or here or here. I would have bought right here. And I know that sounds like a little bit hypocritical, but the way that my algorithms work is that it looks at past data, and then if the candle is fully closed above, that means it's 4 times confirmed. It's not just the close, it's the open, high, low, and close that are sitting above the 180. All right, and you can see how that run worked out pretty darn well. So if we go back to the present, you can kind of see where we are going with this. So essentially, if it gets above 120, if it gets above 125.20, I'm going to start buying with a half position, whatever that means for you. And if it goes below 1607 or somewhere around that, I think that I'm going to start shorting with a full position because it's pretty darn accurate. Because the market is not going to go, I'm going to change direction. I mean, it might, but let's say that there's like a 20 20 to 25% chance that happens. That's pretty good odds that I'm going to win. All right. And then if we look at the RSI, when I was trading, I used to think of the RSI as like a future forward indicator. So as you can see, the RSI is, of course, going up, which means I feel that, well, it was undervalued and it's going up. So how we can read this RSI right here is that since it was already at the bottom, it was at the bottom at September 30th, and it hasn't really gone anywhere. If it starts to go somewhere, then that means that this part was a future indicator of the past. But if it gets all the way up here and it's still within this range, it's a short. I know that's kind of complicated, but well, I would start shorting it. Mainly because it ran out of steam. You got to think of the RSI as like how much power the individual buyers have, essentially. So you can kind of tell if the buyers are exhausted or the sellers are exhausted. So what I mean by exhausted is they don't have any more funds to buy, and I mean they want to see it go up. I mean the buyers want to see it go up, but the sellers want to see it go down. So if they get like all the way up here, let's say like at a 70, I mean a 60 to 70 RSI, and the buyers are like, well, we don't have anything left. We don't have any money to buy. But if we get down here, there's nothing left to sell. So right now we are also in a 50-50 position. But I mean, if it breaks above and it still has some steam left to go, then it is, of course, what I said before, a half position. And if it goes below, it is a full short position. Because what I think is going to happen just in general with the RSI, it's probably going to come up here within the next few days and bounce around the 60-ish and then probably get back down to the 50. Now what that's going to do is they're not correlated. I mean, they are correlated, but they're not really connected with each other. Like if this drops 50%, if this drops like 30%, that doesn't mean this will drop 30%. What I mean is this run could be very much this whole run right here, which means the sellers are not exhausted, which means that might cause even a larger short in the process. So, I mean, looking at all the basic patterns that I'm just looking at here, I'd probably say that there's around it's not a 50% chance anymore. It's a 60% chance that the markets are going to continue to go down. But there still is a 40% chance. So just set your indicators, and I'm not getting into any positions yet. So, you know, it's how it goes. All right, guys. All right, so now getting on to like kind of the next thing that I kind of want to talk about, which is inflation at 8%, interest rates, and the election effects. So let's talk about election effects first. All right. So what's been going on? I mean, I'm not going to talk about any political part. I mean, I'm not going to talk about any policies or anything like that, but I am going to talk about what the investors fear most, right? So what the investors fear most is, and the American people, is mainly the Democratic Party, or the people that are invested, all right? So if you look at the stock market just over the entire Joe Biden's entire run, essentially, shoot. I mean, that started somewhere 2020, somewhere in here, all right? It had a tremendous run, but it lost everything. So since we're on a downtrend and the same person is in the presidency that they are now, if the same person gets elected, then, well, like, not elected, if the Democrat Party still has major control, what I'm saying is investors are going to be very fearful, and, you know, it's probably going to go down. Because, I mean, it's not a boost of confidence to say that nothing is going to change. And considering we're on a downtrend, I mean, there is nothing else to say besides that. Yeah. So, and then if, I don't know, if the Republicans, I guess, or whoever gets elected, or takes majority control, that's going to be a big boost for confidence, because it's a sign of change. And since we're in a downtrend, what's the change? consolidation or an uptrend. So that is what I'm thinking. The technicals, the election effects. All right, interest rates. Interest rates and inflation. I'm just going to group these two into one thing. So they kind of, I mean, of course, we spent all this money, and I mean, I kind of wish somebody from like the government or the Fed would just say, at the very beginning of this, said, you know what, we are going to experience like some troubling times, but as soon as we can get back to hard work and we can actually do it, then everything's going to go back to normal. And I mean, we might have to cut some of our government spending and higher taxes for just a little bit, mainly on wealthy people because they have the majority share of the money. But if you say that, I mean, not if they would have said that, would have been a lot better than. I mean, what they said was, well, there's not going to be any problems, and it'll be transitory. Whatever that just means that it's going to be pushed along essentially, and now we're feeling the effects of it. But interest rates, the main thing about interest rates is when they go up, it is directly correlated with the stock market. Since they pushed interest rates up, the stock market has to go down, which means you can start investing off of that. So, I mean, we could literally just say that if interest rates go higher at any point of this time, start shorting. That's it. If they get lowered, I mean, probably buy some stuff, but be ready to sell because that could just be a false hope for everything. Um, yeah, I mean, there's just a whole lot of stuff going on, guys. So, I mean, just be ready for it. Set your alerts and stuff like that. Um, the next week is going to be a pretty crazy week. So, yeah. All right. See you guys later. Yeah. All right. Rock and roll.